The final statement is the statement of cash flows. And in the statement of cash flows, it's going to tell us where our money came from and where it went to. And it's going to be broken up into three categories: operating, investing, and financing. Ultimately, the goal of the statement of cash flows is to tell us what the change in cash was for the period, so then we could figure out, when adding it to the beginning cash balance, how much the ending cash balance would be. The ending cash balance is the same balance that should show up on our balance sheet. So you might say, well, why do we care about the statement of cash flows? We already know what the ending cash is on our balance sheet. And the answer to that is, I care about where the money comes from and where it goes to. As an example, would you be more impressed if I told you I had $100,000 in the bank that I borrowed? Or would you be more impressed if I told you I had $100,000 in a bank that I've earned over the past several years? I would imagine you'd be more impressed with the fact that I've earned $100,000 than borrowed it, because if I borrow it, I have to pay it back. So having $100,000 in the bank is good information to have as a user, but I really need to know where that money came from in order for it to really be useful in decision making. So that's what the cash flow statement is going to tell us. Again, the cash flow statement breaks up cash flows into three categories: operating, which would be all the cash flows related to revenues and expenses. So when Apple sells us phones, the revenue they generate from selling those phones, the cash that they receive from that revenue is going to be operating. The cost of producing the phone, the cash they pay to produce those phones, is going to be operating. So all the cash flows related to those revenues and expenses are going to be operating activities. The net operating cash flow won't equal net income, because remember, revenues are recorded when earned, not necessarily when cash changes hands, and expenses are recorded when used, not necessarily when cash is paid. So there could be a difference between the cash flows from operations and net income. But revenue or expense related cash flows show up in operating. Investing is going to include cash flows from our long-term assets. For instance, a building or equipment. Why do we buy buildings or equipment? Well, to grow the business as an investment into the future. So purchasing or selling those long-term assets and investments in other companies are going to be considered an investing activity, because we do it to generate future income for the business. It's a long-term investment in order to grow the business. Financing activities are the two ways we finance our business that we discussed earlier, which is through debt or equity. So anything related to our debt, which is the same as liabilities, and our equity are going to fall under financing activities. So when we borrow money from the bank or pay it back, it's a financing activity. When we get money from investors, that falls under equity. It's a financing activity. So all of those items go under the financing section because they represent the way we finance our business. There's some common ones that students screw up, so I'm going to go through those with you. Dividends paid would be a financing activity because we pay dividends from our retained earnings, which is part of equity. Students sometimes hear dividends, they want to put it in investing. That wouldn't be correct. Dividends paid are financing. Dividends received are operating. And the reason dividends received are operating is because they relate to dividend revenue. When we receive dividends, it's because we've earned it. And we already said anything related to revenue or expense is going to fall under the operating section. Likewise, our interest received or interest paid would also be under operating. A lot of times students want to put interest with investing or financing, but interest received would relate to interest revenue, which is part of operating, and interest paid would relate to interest expense, which is part of operating. It's only the loan principal amount that belongs in financing if it's a loan payable, a liability, or the principal amount of a loan receivable, which would fall under investing because we lend somebody money as an investment. So another thing to keep in mind is notes receivable would fall under investing, cash flows related to lending somebody money, and then notes payable would fall under financing because that's a financing activity. It's a type of liability. Only the principal amount of the loan, not the interest. The interest belongs in the operating section. So those are some common errors that students make. So now that I pointed them out to you, I hope you don't make them. So here's an example of the cash flow statement for Lee Natures. And we can see that they have operating cash flows of 87.5. So that's cash flows directly related to their earning of income. And then we have a large amount of an outflow. The negative means outflow. And by the way, if you haven't picked up on it, parentheses in accounting imputes a negative value. So that's cash outflows for buying long-term assets. And then they also received $47 million for financing activities, so they must have borrowed money or received money from investors. That resulted in their cash changing by $9 million, and when added to their beginning cash, we arrive at the ending cash balance of 10.6. What is the point of the cash flow statement? Well, the cash flow statement is going to help the users of the financial statements analyze the company's ability to repay their debts, because you need cash to do that. They're going to help them assess the opportunity for expansion, because again, you need cash to expand and grow the business. And it also is going to help investors determine whether the company is going to be able to distribute cash dividends, because you need cash to do that. So all in all, the cash flow statement is going to tell us whether or not the business has the money to survive in the long term, to pay off their debts, to grow the business, and to give a return to the owners. The operating activity section indicates the company's ability to generate cash from sales in order to meet the company's current cash needs. So in other words, if we look at the operating section, that tells us whether the company is self-sufficient. Are they able to generate enough cash flow to pay for all their expenses and still have some cash left over to grow the business, give money back to the owners, etc.? This last slide related to the financial statements is extremely important because it really connects the financial statements together. The first financial statement we generally prepare would be an income statement, which shows revenues minus expenses. That gives us our profit, which then moves on and is included in the statement of stockholders' equity as part of our retained earnings calculations. So we have our beginning retained earnings, which comes from the previous year's ending balance, plus net income, minus our dividends to give us our ending retained earnings. That ending retained earnings, as well as the common stock balance, carries over onto our balance sheet. So you could see both of those numbers end up on our balance sheet at the end of the period. So the income statement tells us how much income is generated. Then the statement of shareholders' equity tells us how our equity changed through either net income and dividends for the retained earnings or through issuing additional stock for the common stock. And then those balances end up on our year-end balance sheet. The final connection is the statement of cash flows provides the ending cash balance, which should coincide with the ending cash presented on our balance sheet. So A has to always equal L plus E, and in addition to that, the financial statements all connect together. So that's, again, another great way to double check our work and make sure that what we're doing is making sense. So after we record transactions and events, we should see that A equals L plus E in our balance sheet, and that those relationships we just discussed between the financial statements hold true. The financial statements are going to provide us with a good summary of all the different transactions that occurred during the period of time for the business. But they're not really going to give us enough information. Just looking at 4 sheets of paper to summarize billions of transactions really isn't going to be enough. The users are going to want additional information, and that's going to be provided in the form of the notes to the financials. The notes to the financials are an integral part of the financial statements. They provide additional details that the numbers just don't provide. It's basically additional information about how those numbers were created. So all the financials should be accompanied by notes to provide the reader with that supplemental information to allow them to better understand those financial statements. The notes to the financials are commonly referred to as footnotes. Financial statements have different formats sometimes. On our balance sheet, assets are listed on the balance sheet in how easy it is to convert them to cash. So cash will always be number 1. Then receivables, because all you need to do to convert receivables to cash is collect the money. Then inventory, which would be less liquid than receivables. Liquid is how easy it is to convert it to cash, because you have to sell the inventory first, then collect the money. And then after that, property and equipment. Other assets would fit in there under inventories, but as far as what you need to remember, as far as the order goes, it's cash, receivables, inventories, other, current assets, and then long-term assets. Current assets we'll discuss more in a future chapter, but those are assets that will be converted or to cash or used up within a year. Long-term assets are ones that last longer than a year. Liabilities are listed in order of maturity date. So liabilities we pay more quickly are going to be listed first. Account payable is always going to be the first liability, and then our other liabilities will be listed after that. Current liabilities followed by long-term liabilities. Current being ones we owe within a year, long-term more than a year. Usually a single underline, when you see that, it means we're adding the amounts above it, and a double underline means that's the final balance or total. And then we usually include some monetary unit symbol, like in this case, the dollar symbol. This slide is really great because it summarizes the 4 basic financial statements that we spent most of Chapter 1 discussing. It goes through the purpose of the financial statement, examples of what's included on it, and also, more importantly, under structure, are the fundamental equations that you should have learned through Chapter 1's lectures.